Hi, and welcome back again to Tim Bigham's Options and Volatility newsletter. We'll be taking a look this time at some vol captured trades, several possibilities on Sable Offshore SOC, where some big repeated unusual option activity, especially on the call buying side, sets up ideally for several vol capture trades with definitive edge. So let's jump in and take a look, shall we? First of all, here's the scanner. Starting from the beginning of the week, where we saw Stable Offshore start to see big, unusual option activity. They did have a class action suit, which who knows when it will be ultimately, rectified. But we have seen this massive repeat call buying. Here you see 43,000 options trade, which is triple basically the average volume before. You can see implied volatility jumping big time on this as well. IV jumping over 26% and nearest the highest level of the year at the 89th percentile. Then we saw on Friday even more big unusual option activity, right? 139,000 contracts trade, right? Versus now 14,000 average volume because the previous volume increased it slightly. But you see the big uptick again in implied volatility, 14%. Now trading at the highest at 100%, which means the highest IV level of the year. And this is post earnings, it's not earnings related at all. Here you can see just bringing off the stocks trading at the highest IV of the year, certainly SOC being one of those. So that's set up ideally for that vol capture trade. Here's an IV chart. Here was that first day we looked at it on the scanner. Big jump, obviously, in IV. You can see from day to day, here's the previous day to that day, trading basically at the highest level of the year, certainly on the short end. Here it is, as you can see, IV had been pretty much parked around the 80, mid 80 range, right? Then you see this huge jump up in IV. You can see volume exploding as well here, over 117,000 of the Novis traded, 14,000 of the SEPs. Then we saw even more unusual call and option activity. Throughout the week, you can see IV exploded even further, right? As you can see on the short end, now over 150. Back here, it was just under 150. So IV even heading higher here. You can see from day to day, even increasing as we take a look at it. Now trading over 150. And you can see that the put call differential favoring the calls a little bit as far as the volume, and the puts and calls both moving up in unison. You can see the volume increasing continually, right? Steady, big time volume. You can see the IV percentile still at 100%, right? Calls outpacing puts by about a 2-to-1 margin. Here's a look at it on a monthly basis. Here's the IV basically across the spectrum, 30, 60, and 90 day, slightly out of the money, 40 delta puts and calls. And you can see basically parked somewhere as we looked at around that 80 level. Then with that big unusual option activity, IV just exploding to levels we have really not seen over the past year. So we're just looking for opportunities to jump in, follow that big call buying in a couple trades, or if you want to do a vol capture trade, we'll take a look at that. So either lean slightly bullishly with the big call buyers out there, or just look to vol capture in a more neutral fashion, but looking for that IV to revert. So let's take a look at a couple possibilities. Here is a simple buy right trade, right? Which is buying the stock, selling the September calls in this case, right? And here we're selling slightly out of the money September 25 calls. So start at the beginning of the week, basically when we saw a little bit of that call buying come in, right? But didn't have the explosion that we saw. So we can see those Sep 25 calls. We're trading basically right around that 162.5 midpoint. Stock just over $23. So the buy right, buying the stock, selling a call, would have been 21.45, so just under 21 and a half. IV on those calls, as you can see here at 118. After that big call buying all the way to Friday, you can see the stock closed at 22.80. So the stock dropped 28 cents from the beginning of the week at 23.08, but because of all that big call buying we saw out there, right, this huge jump in implied volatility, we see that the calls, even with the stock down, the calls went up in price. So if you're looking to do a covered call trade, right, buy the stock, sell the call, obviously buying the stock cheaper is better, selling the call more expensive is better, sets up ideally for that buy right, which is then cheapened by the 78 cents since the stock dropped 28 cents and the calls jumped 50 cents even with the stock dropping, and even with time coming off, right? 13 days to expiration, 17 days. So you do have 4 days, right, on a short-term trade. The theta on these options, as you can see, -7, right, on the calls here. So you'd expect the calls to go down 28 cents as a function of time, right? Plus go down as a function of the stock dropping as well. Instead, they exploded higher by 50 cents. Why? The big repeat call buying drove the price of the options higher, sets up ideally for a buy right trade to lean bullishly with that call buying, right? Buy the stock, sell the calls. You're basically 55 deltas net long, right? Buying 100 deltas with the stock, selling the call at 45 deltas. So you're leaning bullishly, but you're capturing that huge jump in implied volatility. For those who want to go a little further out, same thing in November. As you can see here, I took just a slightly different time frame on this. So went from the previous day to the next day, right, Thursday to Friday, stock 22.98 on Thursday. That November 35 call, right, at $1.80, right? So that buy right, buying the stock, selling the call 21.18, as you can see here. The IV on that was 114.08. Fast forward to Friday, you see the stock dropped to 22.80, so 18 cents from Thursday to Friday. But that no 35 call that we're looking at actually went up 20 cents. Why? We saw more of that call buying as we just took a look at come in. So again, doing a covered call where you can buy the stock cheaper, sell the call more expensive, right? And that's the components of a covered call or buy right trade, buying the stock, selling the call to basically reduce your initial costs, reduce your downside exposure when you can get both sides to be beneficial. That to me is an edge in the trade. So that buy right got 38 cents cheaper. Why? Because the IV exploded to 121, right, from basically 114 earlier. Interesting to note too that the no 35 calls with the stock at 22.80 on Friday. We're trading to close right around $2. I took a look back, going back previously a long time to August 22nd before any of this big unusual option activity came in to drive up the IV. The stock closed at 27.20 on that date, August 22nd. 27.20. That no 35 call basically at the same price, right? Even with the stock at 27.20, fast forward to Friday, you're looking at the stock at 22.80. So you're looking at a, over a 4-point drop in the stock and time passing, right? But the call price remaining the same shows you how much that implied volatility moved from 81 back in early August to the 121 level, right? How much that held up these November 35 call prices. So in essence, the stock, which back then, right, was 27.20, closed at 22.80. So you can see the stock price 22.80, right, minus 27.20. Stock dropped $4.40, or roughly 20 almost percent, right? We had some time pass, right, of several weeks, right, from August 22nd to the Friday, right, to September 5th. So you'd expect time decay to be a negative as well, but instead the implied volatility increase, right, basically took away the detrimental big drop in the stock price. You'd absolutely think the call would go down in price with the stock getting hammered by 4.5 points almost, and with time passing. But because of all that big call buying and the IV jumping, it negated that. The calls remain the same. So found that interesting as well. Another way to look at it, to take advantage in a more neutral way, right, is kind of an iron condor trade where you're selling and out of the money put spread and call spread both. So I looked at the September 17 put by the 15 put on the put spread side, 27.5, 30 on the call spread side. So beginning of the week with the IV right around that 118, 120 level, right? That Condor was trading at 80 cents, right? Fast forward to Friday when we saw that huge jump in IV, right? Now you're looking at 188 and 170. So IV exploded by almost 50 vol points, right? Driving up the price of this iron condor from 80 cents to $1.02, even though you had all that time passing as well. Time should lower the price of the iron condor, but instead, because of this huge jump in IV, right, on the put side, you went from 128 to 188 roughly. On the call side, 170 started at 113. So this huge jump in implied volatility set up ideally for an iron condor trade short term plus time decay, right? As time passes, right, you'd expect each day that passes the iron condor to get cheaper. It actually increased by over 20 cents because that huge jump in implied volatility outweighed the negative effect of the time decay. And the stock, as we said, really went nowhere, right, over that time frame, 2308 to 2280. So really didn't make too big of a move at all. The bull put spread, taking a look at that as well. This is to lean bullishly, right? So here is the beginning of the week, that 2017.5 bullish put spread. Basically over 10% out of the money, right? Was trading at just over 60 cents, 62.5 cents, and around 125 IV. Fast forward to Friday, IV now at almost 185, so almost a 60-point jump on IV on the 20 puts, right? And you can see that put spread actually increased in price by 20 cents. Yeah, the stock dropped 20 cents, but it's still 10% or more out of the money, right? Not even threatening, basically almost unchanged. And you did have all that time pass, right, from the beginning to the end of the week with the theta on the spread. At about a nickel a day, you'd expect the spread to cheapen with the stock kind of sitting there going nowhere. A week passing, you only have 13 days instead of 17 days to start. But instead, because of that huge lift in IV, the put spread got 20 cents more expensive. And to really highlight just overall how much that IV jump is, I looked at the straddle, right? So beginning of the week, stock at 2308. The straddle selling the 22.5 call and 22.5 put, both, right? That straddle would have been $4.75, give or take. The kind of IV on both of those, right around 119. Theta on this, in other words, time decay, about 14 cents a day. So each day that passes, you'd expect to lose about 14 cents simply as a function of time. Fast forward to Friday, you can see the stock dropped 28 cents, so it moved closer to the 22.50 strike price, right? Selling the straddle, ideally, you want it to close right at the strike price of 22.50. So with the stock dropping more towards 22.50, you'd expect the straddle price to get a little bit cheaper, certainly. Plus, with the whole week passing, you'd expect time decay, the straddle price to get cheaper. But lo and behold, the straddle exploded to almost $6 from $4.75, a jump of $1.25. Why? Because we saw that IV now at 175 on the options, a massive jump of over 50 vol points. And you can see how the theta increase, right? Anytime you get an increase in IV, you have a concomitant increase in theta. So from now till expiration, September 19th, that theta will kick in even more if you sell it here. So this is how we go about identifying trade opportunities here, ones that can lean bullishly, right, like the buy rights, the covered calls, either September or November, or the bull put spread, right, to lean bullishly with the predominant amount of call buying on this massive repeat unusual option activity, or for the straight kind of vol capture trade, right? The iron condor, which is defined risk trade, where you certainly have a very nice edge, or the straddle sale, right, which is undefined risk, right, but you have such a big cushion now, you have almost 6 points, right, for the stock to either go up or down over the next couple weeks, right? So basically over a 20% move and you'll still be fine. So we'll see what happens with it, but this big repeat unusual option activity, especially on the call side, as you can see, sets up ideally for several trades, either leaning bullishly with that call buying or just looking to straightforward capture the implied volatility, which you still do leaning bullishly. So until next time, as always, here's the good trading. Take care.